Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. This is episode 44. What if I told you that you could tap into potentially high real estate returns, sometimes double digits, without fixing a single leaky faucet or dealing with tenant calls at midnight like we discussed back in episode 18? That's not a pipe dream. It's becoming a reality for savvy investors using technology and pooled resources. Today, we're talking about a game-changing way to invest in real estate without direct ownership: crowdfunding and syndications. Forget needing millions or being an insider. These aren't just side hustles. They can be your ticket to premium deals, office towers, massive apartment complexes that used to be locked away for the ultra wealthy. We'll break down how they work, the kind of returns investors are seeing, and why you need to pay attention. Let's dive in. All right, let's start with crowdfunding. What's the deal here? It's simple. Crowdfunding lets you pool your money with potentially thousands of other small investors through online platforms to buy into large-scale real estate projects. Think big apartment complexes, commercial centers, industrial properties, stuff you'd likely never afford solo. Platforms like Fundrise are major players in this space. Now, the growth here has been explosive. Global real estate crowdfunding platforms reportedly raised close to $20 billion in 2023 alone, nearly doubling the amount from just a few years prior. Some surveys even suggest platform participation grew over 10% recently, showing Main Street investors are jumping in. And what about returns? They certainly vary year to year. However, platforms like Fundrise have historically delivered annual returns often in the 8 to 12% range for some of their diversified offerings. They really showed their strength in 2022, delivering a positive 1.5% when public REITs absolutely plummeted over 25%. More recently, their average client return in 2024 was a solid 5.75%, and their income-focused funds have shown annualized yields around 7.5%. Perhaps the most surprising stat: the barrier to entry is incredibly low. You can often start with pocket change. Fundrise famously has a minimum investment of just $10. So why is this a potential game changer? Well, first is the accessibility. Like I said, $10 gets you in the door. This opens up real estate investing, a cornerstone of wealth building we covered way back in episode 3, to practically everyone. Second, you get access to premium, diversified deals. You're investing in portfolios potentially worth billions. Fundrise manages a portfolio valued at over $7 billion for more than 385,000 investors. And third, it's largely about passive income. Dividends often roll in quarterly while you focus on other things. No tenants, minimal headaches compared to direct ownership. But there's always a catch, right? This isn't like stocks you can sell tomorrow. Your money is typically tied up for several years, as these are long-term investments. Liquidity is limited, often only quarterly, and even then it's not always guaranteed. And critically, not every platform is legitimate or successful. You absolutely must do your homework. My take: crowdfunding is disrupting the old way. It's proof you don't need to own the physical property to potentially profit from prime real estate. Now let's level up to syndications. This is where you actively team up with a group of other investors, usually accredited investors, and crucially, an experienced sponsor or general partner, GP. Together you buy something significant, maybe a $10 million apartment complex or a commercial development. The sponsor does the heavy lifting, finds the deal, manages the project, executes the business plan. You, as a limited partner, LP, provide capital and collect potential profits. What about the payoff? This is where things can get really exciting for those who qualify and are comfortable with the risk. While past performance isn't guaranteed, and recent market conditions have presented challenges, experienced sponsors running value-add or opportunistic real estate syndications often target internal rates of return, IRRs, in the 12% to 18% range, sometimes even aiming for 20% plus on riskier development or distressed deals. That's the kind of potential return that attracts serious capital. How does it work structurally? Well, minimum investments are typically much higher here, often starting at $25,000, $50,000, or even $100,000 plus. Unlike crowdfunding's broad funds, you're usually investing in a specific property or project with a defined strategy and timeline, like renovating an apartment complex and aiming to sell it in 5 to 7 years. As an LP, you often get a share of the rental income, a piece of the appreciation when the property sells, and frequently what's called a preferred return. That means you get paid first, up to a certain percentage like 6 to 8% before the sponsor takes their share. So why is this attractive to investors with more capital? First, you get access to elite specific deals, the kind of Class A assets or large-scale developments usually reserved for institutional players. There's also often higher transparency. You know exactly which property your money is in and what the specific plan is for adding value. But with higher potential reward comes higher risk. The investment minimums are substantial, and your success really hinges on the sponsor's expertise, track record, and integrity. A bad sponsor or a flawed business plan can lead to significant losses. Your due diligence on the sponsor is absolutely paramount. My view, syndications are the heavyweight division for passive real estate investing. If you have the capital, meet the accredited investor criteria, and have the risk tolerance, the targeted returns can be significantly higher. This is a strategy where substantial wealth can be built by backing expert operators. Okay, so crowdfunding and syndications both offer ways to invest without direct ownership, but they're clearly different animals. How do you choose which one is right for you? Let's put them side by side. Crowdfunding really shines with its accessibility and diversification. The pros? Super low minimums, $10 to $100 gets you in. You're instantly diversified across many properties, and it's great for beginners. Plus, platforms have shown resilience, sometimes outperforming public markets in downturns. The cons? You have less control over specific assets. The potential returns might have a lower ceiling compared to a home run syndication deal, and liquidity is still quite limited. Syndications, on the other hand, are about targeted deals and potentially higher returns, but they come with higher stakes. The pros? You get access to specific, often institutional quality deals. Sponsors target higher IRRs, often 12 to 18% plus. And there's more transparency into the specific asset and plan. The cons? Much higher minimum investments, $25K and above. You must thoroughly vet the sponsor. There's concentration risk in single deals, and they're generally limited to accredited investors. So which is better? It really depends on your situation and goals. If you're starting out or want broad diversification with low hassle, crowdfunding is fantastic. If you have significant capital, are accredited, comfortable with higher risk, and want a shot at higher returns by backing specific deals and expert sponsors, syndications are where you look. Both strategies, however, allow you to acquire assets that generate passive income. Key concepts from episode 24 and episode 25 without the headaches of being a direct landlord. But here's the critical warning, and I can't stress this enough. Due diligence is non-negotiable. The SEC has charged crowdfunding portals and sponsors with fraud, misrepresentation, and misappropriating investor funds. Just because an investment is easily accessible online doesn't mean it's safe. You have to vet the platform, vet the sponsor rigorously, understand all the fees, and read every single document. This really echoes the risks we discussed with new financial tech, like back in episode 38 on tokenization. Innovation always requires investor caution. My advice: the potential returns using these methods are real, but so are the risks. Don't make lazy choices. All right, your challenge today. If you're new to this, I want you to explore a major crowdfunding platform like Fundrise, Arrived, or Ground Floor. Just visit their site, understand their models, maybe even take that first step with the minimum $10 or $100 investment to get your feet wet. If you're an accredited investor ready for bigger plays, start researching syndication sponsors in a niche you understand, perhaps multifamily or industrial, and look into their track record. Either way, take action. Stop sitting on the sidelines. Explore these powerful avenues for building real estate wealth. And as always, if you found this episode insightful, please subscribe to the 5-Minute Prime podcast, share it with someone looking for smarter ways to invest, and leave us a review. You can find more resources, tools, and our previous episodes at reiprime.com. I'm Martin Maxwell. Remember, the best real estate strategy for you might not involve owning a single brick directly. Keep learning, stay sharp, and keep building your future.